Now we start our discussion of today on the topic of finance, which we will later also break down into subsections of interest, banking, and inflation. So this is a new topic for this new lesson. Our previous topic was about financial documents. And in financial documents, we discussed a lot. We saw how personal documents can be used, like personal financial documents, like utility bills or possibly pay slips. We also had a discussion of things like cost, that is cost price, and selling price. We also had other discussions, which were included all under the concept of financial documents. Now, in this section of finance, we are going to be very specific and we will deal with interests, banks or banking, and inflation. Now, this section, which we are going to start with, which is interest, okay, is part of the financial application topic, and it is drawn from the CAPS document. And as it is indicated, as it is stipulated, as it is required for you, the grade 11 learners, you will need specifically to be able to understand the differences between simple and compound interest. We will have a very good discussion, a detailed discussion on interests, and we will break it down, or we will divide it into simple interest and compound interest. Then later, you will need to be specifically able to perform simple and compound interest calculations manually, that is without using a formula, and also as you will be using a formula. Okay, we will also look into discussions on that. Then later, you will need to be specifically able to make sense of graphs drawn to represent simple and compound interest. We will be having a calculation and discussions involving calculations where graphs are already drawn, and you will be required to have or to interpret, to generate some information based on the graph which is already drawn. Now, before we look into that detail, which will come with the concept of interest, we want to look at some of the basic terms that we are going to be using in the discussion of this topic of finance, which, as I indicated earlier, is going to be split into interest, banking, and inflation. Now, the first term we would like to find out is interest rate. What is interest rate? Now, the rate at which amount of money that is invested increase in value is what we call interest rate. So you think of getting some money or having some money and investing it, okay? You could be like buying shares in a company, or someone possibly borrowed some money from you, or you possibly kept it in a bank account. And now, after some time, that money is expected to have increased in value. Now, this increase in value because of the money invested is what we call interest or interest rate. The rate of interest most of the time is expressed as a percentage, and it can be compounded, that is added over a monthly period, a quarterly period, that is every after 3 months, or a yearly period. That is the first term, the interest rate, okay? The rate at which the amount of money that you invested in some kind of a project increase in value. You know, when you identify a business and you want to invest your money in, you do that expecting that your money will increase in value. So when your money increases in value, that rate at which it is increasing in value is called the interest rate. The next term we want to look at is called the investment life or investment term. This is the time that a person commits to an investment. So for example, if you have some project you want to do, or maybe you want to buy shares in a given company, for example, ShopRite or Spar or, Click or something like that. If they are selling shares, then you will be like, well, I'm going to buy this share. Then after buying it, I will wait for the value of the share to increase over a period of 2 years. Then I sell my share, expecting that the value of the money you invested in buying the share will have increased. So that time period that you've set to guide your investment, that is, you want to have your money invested over this period of time. That is what we call investment term, also known as investment life. The next thing is monthly payment. So the third term we want to investigate and discuss is called monthly payment. What is monthly payment? Well, as it is indicated, monthly. That is every month payment. In simple terms, the amount of money that the person must pay every month into their investment is what we call monthly payment. Okay. Now, the next thing we want to look at is called principal. Now, principal is the amount that a person invests initially. So, for example, if you have shown interest in investment and you want to invest some amount of money in that company, that money you want to invest into the company is what we call principal. There are some other terms like borrower, someone who takes out a loan, okay? Someone who borrows money in the form of a loan is called a borrower. Then the other term is called deposit. Now, deposit is the sum of money which is payable at first as a first installment on purchase of something or as a pledge for a contract, the balance being payable later. So it's like when you go to buy something on a lay-by, okay? You want to buy something and you don't have all the money. Let's say you want to buy a laptop. Now, if you want to buy a laptop and you don't have the money, all the money at once, the seller can allow you to buy in bits, in installment. That is, you lay-by. Now, lay-buying means you have to pay some money as initial deposit, then you come with the remaining money after some period of time, like over a monthly period. After 1 month, you bring some money. After the other month, you bring some more money, you see? So this amount of money which you give as the first payment for the phone or the laptop that you want to take after finishing the payment is what we call a deposit, okay? So it varies. Lay-by for the most time is 3 months. Sometimes it's 4 months. Sometimes you can be given after a period of 6 months. But the first money that you give so that the item you want to buy is kept in your name is called the deposit. So by definition, deposit is a sum of money which is payable after a first installment, okay? Rather as a first installment, not after, sorry for that. A sum payable as a first installment on the purchase of something or a pledge of contract. So you make the first payment as a pledge, as a commitment payment. Installment means like the first part of what you have to pay. The next term we want to look at is called the loan life or the loan term. Now, the amount of time it will take a person to pay off loan is what we call the loan time. So you got a friend who wants some money, he wants to buy a house, but he's not having all the money at once. He is borrowing some money from you and he is refunding that money after a period of 6 months. That money which he is refunding over the period of 6 months is a loan. And the time taken, which is 6 months, is what we call the loan term or the loan life. The other term that we want to look at is called the lender. Now, the lender is the person, an institution that is giving somebody a loan. Okay, so when you find an institution or someone who is giving out loan, this person is called a lender. The other thing that we want also to look at is called the real cost of a loan or the total cost of a loan. Now, this is the principal loan amount plus all the interest payable on the loan. That is like when the bank has given you some money, let's say 200,000 rands, and you are supposed to do an investment and pay, and you are supposed to pay back with some interest, which, you know, altogether will add like to 250,000. The whole amount of money, the loan, plus the extra money that you have to pay as interest when added together is what we call the real cost of a loan. Well, interest rate, we already saw it. It's appearing again, the rate at which a person is charged for loaning money, and it is expressed as a percentage. Okay, so because you want to take some money as loan, you will be charged, so that when you are paying back that money, you pay with some more money onto it, because the money you have received will have assisted you to do something. So the person giving you that money will want some payment because of helping you out. That is called the interest rate. It is normally expressed as a percentage. Then there is what we call the residual value, sometimes just referred to as the residual. This is also known as the balloon or a balloon payment. Is a part of a loan which has to be paid after the loan term. So if you have got some loan and you have not been able to pay it over this period of time, that balance which is collected after the loan time or the loan life or the loan term, that is called the residual value, and it is collected as a lump sum. So we are getting back into simple interest. Now, simple interest can be calculated really quick. Now, as I indicated a little bit earlier, simple interest is that extra amount of money which is charged on the money you are taking, the money you are loaning. Okay, when they give you money as loan and you are supposed to pay back some more money, that money is called interest. Now, simple interest is calculated from the original amount. So for example, when we look here, we have 500 rand growing at a simple interest rate of what? Of 10% for a period of 3 years. What would be the simple interest? Well, the simple interest can be calculated with a lot of ease. Let's see how we can calculate the simple interest. So we have this amount of money, which we are calling principal, and it's how much? It's 500 rand, okay? So the simple interest is going to be 10% of 500. So how do we write 10%? Well, 10% is written as 10 divided by 100, okay? So it's of a period of 3 years. So we say simple interest for the first year. going to be 10% of how much? 10% of 500, rands. When we do that, what do we get? Well, we get 50. Now, this is a period of 3 years. So how else do we handle this? Well, we say for the second year, okay, interest for the second year, okay. In the second year, the same way. Remember, we have been given here 10% for 3 years. So in the second year, we'll calculate it the same way. How is that? Having 10%, that is 10, 100, okay? Times what? Times the initial amount of money, is 500.00. How much is this? Well, 50 rands. Simple interest in the third year, okay? Interest in the third year. How do we calculate that? Well, the approach is still the same, okay? Remember, in the first year, second year, and third year, the approach of calculation is still the same, and we calculate based on the initial amount of money. And so what is that going to be? Well, that is going to be 10%, that is 10 out of 100. Later, times what? Times. Wait, how much do we get? Well, we get 50. So now, over a period of 3 years, okay? So we say, very much like the total simple interest. 3 years. It's going to be simple interest for the first year. 50. We add that to the simple interest for the second year, which is also 50, plus the principal, the simple interest. Yeah. How much is that going to be? Well, it's going to be, that is the simple interest over a period of what? Over a period of 3 years. Now, how about the compound interest? Well, the compound interest is calculated based on the compounded amount of money. It's like trying to say, in the first year, interest is going to be earned. That interest is added onto the money, onto the principal, onto the original amount of money. Then that original amount of money is used to calculate the interest for the following year, okay? So it's like trying to say interest, okay? Interest is going to be still 10%, okay? So compound interest in the first year. Well, in the first year, we use the principal. So we are going to be having 10%. That is 10 divided by 100. Okay. 10%, that is 10 divided by 100. Times what? The amount of money, which is what? 500. What is that? That is 50. Now, in the second year, do we calculate that? Well, let's add this amount of money, which is the interest, onto what? Onto the original amount of money that we had. 10%, okay? 10%. What? 10% of the new amount of money. And what is it this time? Well, it is 500. That is how we calculate what? The compound interest in the second year. And so this is going to be 10%. 10% is what? Times 500. Well, using our calculator, what do we get for that? It is going to be 10% of 550. Let's see this. This is going to be 55. So we write it down. This is 55. You see? So in the first year, it was 50. That is the interest. In the second year, it's now 55. What do we get in the third year? It's a compound interest. In the we calculated a similar approach, that is 10%, which is 10 out of 100. 10 out of 100 of this new amount, the new amount of money, okay? 10% of the original amount of money plus the interest. Okay, so this is going to be, the new amount of money is now going to be 55. What do we get from here? Well, to be 10% out of 100. 10 out of 100. That is times. Well, this is 555. As well, let's check with the calculator how this is going to be calculated. This is going to be 55.5. Okay, so this is going to give us 55.5. That is what we get. Okay, so the interest keeps on increasing and increasing and increasing like that. So that is how we get the what? We keep compounding, we keep compounding, we keep compounding. Okay, so this is how we calculate the compound interest, because in the first year we had this. So the new amount of money has changed to 550. Okay, then in the second year, we had this, oh, sorry, my apology. This was supposed to be 500. The new amount was supposed to be 550. Yeah, this is the new amount. Because in the first year, now notice that in the first year we had 50. So for the second year, this interest is added onto that so that we get 550, which is what we got here. So from the 550, we got this. Then now, this 550, which we calculated, is going to be the principal for the third year. So we'll be having 550 plus this one, which would give us what? Which would give us 605. Apology for this. This is 605. Yes. That is when we add 550 to what? To 55. We get 605. So this way, we can now do what? We can now go ahead to calculate. And what we get here is 60. Yes, this is how we calculate the compound interest. So the compound interest over the period of 3 years is what? 0.5. This is what we have calculated. In the first year, it's 50. In the second year, it's right here. The fourth year, this is what we have. That is 60.5. This is how we calculate the compound interest. Okay. So now, here is one more activity for us. Let's see how we are going to handle this activity. They're saying Kim wants to buy herself a new television. She looks at her finances and realizes that she does not have the money to buy a new TV right now. So she decides to buy a TV on a hire purchase agreement. Hire purchase agreement means you go to the shopkeeper or to the shopping mall or to the TV shop. You make arrangement with the supplier. You take the TV at home after making initial deposit, some money. Then the remaining amount of money, you pay it over some period of time, like monthly, maybe over 1 year or 2 years time. And it's a very common method of payment at the moment in the market. So let's see how we are going to handle this section. So to handle this section, well, we are supposed to do what? This is, we're calling it second activity. So this is activity 2. Activity. So this is the piece of information that we have. What else do we know? Well, apart from the general statement about Kim, we are supposed to calculate how much Kim would pay for the deposit. This is the TV. This is the description. The cash price is 12,999. This is the cash price. If you're paying by installment the way Kim wants to pay, then the method is called hire purchase, in which case you pay 14% deposit and then 24 equal monthly payments to the value of this. This then means if you're going to buy with the hire purchase method, then you will first make a deposit of 14% of the initial or original amount of money. Then you make 24 equal monthly payment, which will add up to 13,191. Okay, so what do we do then? Well, in this case, we want to calculate how much Kim would pay for the deposit. Now notice that the deposit is 14,000, rather 14% of what? Of the cash price. So that is activity part A. Activity part A. 14. The deposit is 14%. Out of 100 of what? The cash price, which is 12,999. Okay. How much is that when calculated? Well, let's check. So this is going to be 12,999. Okay, times 14%. That is times 14%. So that is going to be 1,819. So this is going to be 1,819 point what? 19.86. That is the deposit. The deposit is 14%. 14% means 14 divided by 100 of what? Of 12,999. Now the next thing we want to do is to calculate for what? Is to calculate for how much will Kim have to pay every month. Now notice that after making the deposit, Kim has to make equal payment over a period of 24 months. And that money must add to what? 13,191. So the monthly payment, okay? We say the monthly payment is going to be what? Is going to be this amount of money, which is 13,900 rather and 191 point what? 9 rather. Amount of money which is supposed to be what? Supposed to be distributed or paid for over a period of what? Of 24 months. So when we divide this total amount of money with 24, we will be able to get the monthly amount of money that Kim will pay for the TV. Do we handle that? Well, we now have 31, but rather yes, 13,191 point what? 0.39. We want to divide this by 24. What do we get? Well, it's going to be 549.64. What? That is the amount of money that Kim must pay monthly if she is what? If she is to make a total of 13,191. The next thing we want to look at is question C. Now in question C, we are supposed to calculate here the total amount that Kim will pay for her new TV on hire purchase agreement. Well, the total amount of money hire purchase is going to be the deposit, okay? It's going to be the deposit and the monthly payment. The deposit and the monthly payment. This, well, the deposit is 1,119 point what? 86. To it we add 13,000 and what? 191.39. 39. When we add, what we get is the total amount of money. So let's add, this is 181, 9, comma what? 86. This we want to add 1,191 point what? 39. That will give us 15,011.25. That is 11 point what? 0.25. That is what you will have to pay. Okay, that is when you now add the initial deposit and the amount of money that she is going to pay over a period of 24 months. The next thing, which is the last part of the question, is asking us how much interest will Kim pay for her new TV on the hire purchase. So now the interest in this case will be calculated when we get the difference between what? When we get the difference between the hire purchase payment from it we take away what? From it we take away the cash price payment. Yes, we will be having, well, 15,000 and 11.25, that is comma 25. Yes. Cash price, and how much is cash price? Cash price is 12,000. Okay, 12,999. We can calculate the what? The interest. Not the interest rate, but the interest. So how much is this as interest? Well, let's check. So let's check this. The interest is 2,012.25. So the interest is 2,000. This is one activity on how interest can be calculated, plus the other related quantities. We talk of deposit, okay? We talk of the monthly payment, which we had already defined in the previous step, okay? We saw that the deposit is like the first installment which is made for the payment for a product, with monthly payment or the balance being paid over a period of time. The first deposit you make when you're buying something on installment payments is called deposit. Monthly payment is the amount of money that you pay every month, you know, to buy something or as an investment. So this gives us a brief introduction and for the topic of today, which is what? Which is finance, covering the section of interest. And after interest, we will later look at banking and what? And inflation. So this is about interest. We are yet to have some more activity, which will be coming in the next series of videos. So please check out for it.